This is not where inflation shows up first. It is where equity supply quietly disappears, and by the end, it will be clear why this wave matters more for price than growth. In our strategy, risk is tracked through a 5-phase cycle. Sequencing matters more than timing. Optionality matters more than conviction. This segment focuses on Wave 3, corporate repatriation. The claim is that roughly $2.1 trillion returns to the United States between May and August of 2026. What matters is not the headline size, but how that cash is deployed. The chart breaks deployment into 4 buckets. Share buybacks dominate. Dividends follow. Mergers and acquisitions come next. True capital investment is the smallest share. This is a price support story first, not a productivity surge. Here's what most people miss. The real economy may not feel this wave immediately. Markets often do. When buybacks dominate, equity supply shrinks. When dividends rise, passive flows stabilize. When real investment stays limited, growth does not accelerate enough to offset higher discount rates later. That mix defines the phase pressure. If this deployment mix holds, it raises Phase 1 continuation probability modestly. Index levels can remain supported through mechanical demand. But it also increases Phase 2 sensitivity later, because payout-driven rallies rely heavily on cooperative rates. The window compresses rather than extends. This is where it becomes actionable. The trigger is not the repatriation announcement. The trigger is whether rates allow the market to keep the support. This wave confirms only if 3 signals align. Buyback authorizations accelerate. Dividend guidance rises. Long yields remain contained while equities advance. If yields rise alongside equities, this wave weakens. Quick disclaimer, this is educational macro commentary, not financial advice. These are not buys. These are the tickers most sensitive if this wave persists. SPY for broad index exposure. SMH, AIQ, and CHAT for high beta duration sensitivity. TLT and ZRAs as the rates regime constraint. Gold and silver as late cycle inflation sensitivity. Oil for real economy pressure. BTC for liquidity regime behavior. Before this signal, Phase 2 risk sat in a moderate range. This wave nudges that risk higher later in the year. Not certain, but closer, because payout-driven rallies depend on stable discount rates. In our strategy terms, this is approaching ladder watch zone, not a buy window, but no longer distant. If yields remain calm, the window can extend. If yields rise, the window compresses quickly. Hold this thought. Strong markets can coexist with rising fragility underneath. The primary risk is not sentiment or politics. It is term premium. If long yields reprice higher, buybacks lose their protective power fast. This wave loses weight if buyback activity does not accelerate, if credit spreads widen while leadership narrows, or if yields rise faster than earnings expectations. Wave 3 is about cash coming home. Our strategy translation is simpler. It can support price in the short term while increasing late cycle sensitivity. That raises Phase 2 risk later, not immediately, but meaningfully. The real signal is not the cash. The real signal is whether rates allow the market to keep it. Analytical question. If this wave disappoints, does credit crack first, or do long yields force the turn?